Welcome to the Deep Dive. Today we're looking at a major move in regional banking, a really historic institution making a decisive play that I think fundamentally changes its story.
It's a big one. This isn't just another small deal. For, over a decade, Commerce Bank Shares, that's ticker CBSH, has been all about slow, steady, organic growth.
Right. Very disciplined.
Extremely. But today, January 1st, 2026, they've officially closed their acquisition of FineMark Holdings. This is a very deliberate, very calculated pivot.
And it's their first major bank acquisition in almost 13 years. The last one was Summit Bank Shares way back in 2013. So the mission here seems crystal clear.
It is. They want to accelerate growth, but not in their usual way. They're going straight for the high net worth market by buying the specialized wealth management footprint.
And the scale jump is pretty immediate.
It's impressive. The new combined bank has about $36 billion in assets, but that's not the number to watch. The real story is the $90 billion in assets under administration, the AUA.
$90 billion. So that vaults them into, what, the top tier of bank-managed trusts nationally?
Pretty much. Pro forma, they're looking at being around 15th in the country. So you can see this deal was all about buying relationships and fee income, not just bank deposits.
Okay, so let's set the stage a bit. Why is a bank like Commerce even in a position to do a deal like this? It's not just any bank.
No, it has deep roots. It was founded back in 1865.
And it had some, fun historical footnotes. Harry Truman worked there briefly.
Right, and they gave the line of credit to the founder of Bass Pro Shops. But the history that really matters for this deal is from 2008.
The financial crisis.
Exactly. Commerce was the sixth largest U.S. bank that famously refused the TARP funds. They just didn't need the government bailout.
And that thread of independence and just rock-solid financial discipline, that's the key here. It tells you everything about the quality of their balance sheet.
It does, which is why when they finally decide to pull the trigger on an acquisition, they're not bargain hunting. They're buying a premium specialized asset like FineMark.
Okay, so let's talk about that prize. What exactly does FineMark bring to the table?
Well, on the balance sheet, it's $7.7 billion in AUA and about $4 billion in bank assets. But the real win is geography. Commerce already had a bit of a presence in Florida, and this deal supercharges it. But more importantly, it gives them brand new locations in Arizona and South Carolina. They're putting their money where wealthy clients are moving.
But there's a really fascinating piece to this that you don't see in a typical bank deal. Their specialized niche. I'm talking about the sports management division.
Yeah, this is the kicker. This one little division manages about $600 million in AUA for roughly 300 professional athletes.
Wow.
It's a super targeted, high-touch client base that Commerce now just instantly owns. It's a pipeline to future wealth that's very hard to build from scratch.
And that specialization in wealth management, it has to have an impact on their overall business model, right?
Yeah.
I mean, a lot of regional banks are so sensitive to what the Fed does with interest rates.
It's a huge economic shock absorber. That's the best way to think about it.
How so?
FineMark's revenue is heavily weighted toward fees. About 43% of their income comes from managing assets, not just lending money. That fee income is stable. It doesn't really care if rates are high or low.
So it provides a buffer. It makes their overall revenue much more predictable, which the market loves.
Exactly. It's a move towards stability.
Okay, so this feels more like a strategic necessity than just a good opportunity. Let's unpack the deal itself. It was an all-stock transaction.
Right. Commerce used its own stock to buy FineMark, which, shows a lot of confidence and aligns all the shareholders for the long term. FineMark shareholders got Commerce stock based on an exchange ratio.
But that ratio actually changed a little bit between the announcement and the close. What happened there?
Yeah, it's a small but important detail. Commerce declared a 5% stock dividend in October of 2025. That was after they set the deal price, but before it closed.
Ah, so that would have diluted the value for the FineMark shareholders.
It would have, slightly. So to keep the deal's original value intact, which was at about $585 million, they adjusted the exchange ratio up a little bit from 0.690 to 0.7245. It just shows they were focused on being fair.
Which builds confidence. Speaking of which, let's talk about the big number investors care about. Accretion. The deal is expected to be about 6% accretive to 2026 GAAP earnings. Why is that number so good?
It's a really strong sign of efficiency. I mean, in the regional banking world, any accretion over, say, 3% or 4% on a big deal is considered pretty good. So hitting 6% right out of the gate suggests the deal is just immediately productive.
And what about the other side of that coin? Usually a deal like this means you take a hit on your tangible book value per share. There's dilution. How bad was it here?
That's the most impressive part. The dilution was almost nothing, just about 2.2%.
Only 2.2%. That is surgical.
It really is. And the time to earn that back, the TBVPS earn back period is forecast to be just 1.6 years.
A year and a half.
Yeah. I mean, the industry average for a deal like this can easily be 3, 4, even 5 years. So 1.6 years is just exceptionally fast. It speaks to the efficiency of the deal structure.
And they did all of this without touching their famous capital strength. The common equity tier 1 ratio is staying around 17% after the deal. How important is that?
It's crucial. A 17% CET1 ratio is just a massive buffer. It tells regulators and investors that the bank is incredibly safe, and importantly, that they still have plenty of firepower for more lending and growth. This wasn't a bet the farm deal for them.
Okay, so the financials look almost perfect. But we all know that bank mergers can look great on a spreadsheet and then just fall apart. The execution is everything.
That's where all the focus is right now. And to their credit, they seem very aware of the risks. They've put a huge emphasis on keeping the FineMark identity and its people.
So the brand stays.
The brand stays. It's now going to be called FineMark Bank and Trust, a division of Commerce Bank. They're trying to preserve that boutique feel that the clients love.
And leadership is obviously key for keeping those high net worth clients from walking out the door.
For sure. And they lock down the most important person. Joseph Ketty, who is the chairman and CEO of FineMark, is staying on. He's going to be chairman of Commerce Trust and CEO of this new FineMark division. That signals continuity.
So if the brand is safe and the leadership is staying, what's the single biggest risk to actually hitting that 6% accretion number? Where could this go wrong?
It all boils down to one thing: integrating the operational systems, the tech.
The dreaded systems conversion.
That's it. It's the biggest technical hurdle, and they have it officially scheduled for the second half of 2026.
So until that happens successfully, all those synergies and cost savings that make the deal 6% accretive, they're basically just on paper. They're theoretical.
You've got it. That conversion is the catalyst. If it hits any snags, technical glitches, data problems, anything, it creates massive headaches, it could disrupt clients, and it definitely delays those financial benefits. The timeline has to be perfect.
But it seems like the shareholders, at least, were very confident going in.
Overwhelmingly so. At the FineMark shareholder meeting, over 99% of the votes cast were in favor of the merger. That's about as close to unanimous as you can get.
So for anyone listening and watching Commerce over the next year, what are the key things to look for to see if this is working?
You want to watch two things. First, keep an eye on the growth of assets under administration, the AUA, specifically in Florida, Arizona, and South Carolina. If that number is going up, it means they're keeping clients and winning new ones.
In the second thing,
Look at the fee income coming from the FineMark division in their quarterly reports. If that number is strong and growing, it means the core reason for the acquisition, adding that stable, diversified revenue, is actually working.
so when you step back and look at the whole picture, what's the big message Commerce is sending with this deal?
They're showing the market that their decades of discipline weren't about being timid. It was about building a resource. They used that strength to pivot into high-growth wealth management, and they did it with incredible financial metrics. The whole conversation now is just about one thing: execution. Can they stick the landing on that 2026 systems conversion?
That's the big question. And let's not forget about that unique asset they picked up, the sports management practice.
Right. It's both a huge opportunity and, a unique kind of risk. You're now managing the wealth of professional athletes, which is tied to their careers, their public image, their collective bargaining agreements. It's a very concentrated and potentially volatile client base to have under the bank's roof.
Okay, now before our final thought, just a quick reminder for everyone listening.
Yeah.
Everything we talk about here is for educational purposes. This is not financial advice. But with that said, let's talk about a tactical opportunity, an outrageous but plausible trade idea based on this.
So we've already established the single biggest risk, the main pressure point, is that systems merger in the second half of 2026.
So the play would be to short Commerce Bank share stock, CBSH, during the summer of 2026. The timing is meant to get ahead of that critical systems conversion.
Right. And the logic is you're betting on a combination of internal stress and an external shock. If Commerce has any kind of technical delay with the IT merger, the stock will dip because that 6% accretion timeline is suddenly at risk.
And then here's the amplifier, the external shock. Imagine that technical problem happens at the same time as, say, an unexpected long lockout in the NFL or NBA.
Or a huge league-wide scandal.
Exactly. Suddenly you have massive pressure on that new $600 million sports wealth division right when the bank is already struggling with this complex internal project.
That perfect storm of client stress, compounding internal chaos, could absolutely crater investor confidence, at least for a little while, and force a pretty significant short-term drop in the stock price. The systems conversion is the risk. The sports division is a volatility multiplier.
And that convergence creates the window for the trade. Thank you for joining us on the deep dive. We hope you feel up to speed on the Commerce FineMark deal, and we'll see you next time.